Hey, good morning, everyone. Marty Missouri here, Wednesday, the 14th of September, 2022, with your midweek market snapshot. I can keep this one pretty quick this morning. We'll look at the daily, we'll look at the hourly, we'll look again at the dollar, and then I want to look at futures, traders' net positioning for the dollar and for the euro, and put that into an equity market context. So, folks, we saw quite the sell-off yesterday, as you know. In fact, let's just look at the price chart. 4.2% on the S&P. I think the NASDAQ was down like 5%. As I said in the morning note, really only took us back to last Tuesday in terms of the areas or the level that dropped down to. What was very much of note to me, though, was that we closed right on this trend line, right, where we noticed this here at 3,900. We had, options dealers positioning, and then these technical levels and support that said we might get a bounce, that it was pretty likely. We did get that bounce. Fell apart on yesterday's CPI number. And if you haven't had a chance, yesterday's morning note just touched on that. And then, of course, this morning as well. And this morning I got a little deeper into the inflation setup going forward that's probably worth reading if you need a refresher on our view on inflation going forward. So anyway, we came down today, tried to so far break that level, and as I speak, we're holding up. This is a delayed chart. In real time, the S&P is up a big 0.75%. So we'll see if we can hold on to that today. It would make a lot of sense to get a kind of a rebound. Could be a dead cat bounce. That would be my best guess. But certainly off of these technical levels. We've got this 50-day moving average to contend with, the top of yesterday's bar and so forth. That would be a really big move. I would be surprised if we get that. But yeah, I was surprised by yesterday's CPI number. Again, not to be too redundant because I touched on this morning, but the fact that the market responded so aggressively to that number kind of speaks to the lack of credibility for the present Fed board, meaning that they've been telling us that regardless of yesterday's CPI number, they're going to go pretty aggressively, historically aggressively, going forward. What I think people freaked out about yesterday was such a surprise that maybe they go 1 full percent, right? Maybe they go 100 basis points instead of 75. As I speak at you here this morning, the Fed funds futures are pricing in a 34% chance of a 100 basis point hike. Instinct would tell me to push back against that, given the history of the present Fed members, but they're talking pretty tough, so that would be a shock, and that would do a number next week on equities again. I think we'd see this kind of action. And then remember, folks, we won't go to those long-term charts today, but in our long-term technical analysis, we have like 3,500 staked out. So regardless of when it comes, it looks to us still like we have lower lows in this bear market. But as for the moment, we'll see. Today's rally, maybe it holds. We don't have that setup like we had day before yesterday where the market rallied like it is today, at least as I speak. And the VIX was up 5 or 6% all day. And that suggested that people were coming in and buying short-term put options. You had dealers having to aggressively hedge what's called their gamma as the market fell apart yesterday. And that no doubt exacerbated the downside, I'm sure. Today, we don't have that dynamic. We have a VIX that's down 2.5%. So that, gives a little more support to maybe we end in the green today. But you would sure think with yesterday's CPI number and what the Fed have set up to now, they can't talk for the next week because it's too close to the meeting, that, that people would look for opportunities to sell the rallies, you might think. Technically speaking, though, this looks promising to the bulls, at least short term. You break down through here, and suddenly 3,800 has very little resistance between 3,900 and 3,800. And then from there, you probably find some support around here, and then you get down here to the June low, which some people have staked out. Again, we think there's more. Okay, so that's a look at the daily. Let's do our quick view of the 60-minute chart. So we had this uptrend, but we did have a bearish divergence here developing on the RSI, and then you had the MACD ready to roll over from a pretty high spot. Gap down yesterday, and then fighting here with that 39.50 resistance level. Nick and I kind of staked out 39.20 as yesterday's bottom, and I think we bounced right off of that 39.21. I think it was 39.27 is what we had staked out. 39.21 was the bottom that the market bounced off up a little bit yesterday. And again, coming off of that, looking at this right now in terms of, you could effort here to draw a pattern. I'm really not inclined to. I want to see more things develop. But again, you are finding support right there this morning. You could argue that the RSI got a little oversold here almost, and then you're getting a bullish divergence there, not so much on the MACD. So yeah, I don't have a strong feeling one way or the other. Short-term bullish versus bearish. You would lean towards a bounce based on what we saw in that daily chart. Getting it to some degree as I speak at you here at the moment. Let's take a look at the dollar. So key to the rally that we saw this last week, and we touched on this here the other day, was the dollar rolling over, right? And our technical analysis of the dollar said that's a due, right? Yesterday, though, when you had this surprising CPI number, which screams higher interest rates, and you get a higher interest rate differential between, dollar assets and, say, Eurozone assets, so to speak, fixed income assets, it makes the dollar attractive. I mean, some people, that's all they think about is the interest rate differential. There's lots more to it, but right now that's a big influence on the dollar. So we got that big bounce yesterday. Stocks just careened. So to the extent that the dollar explained that nice 4-day rally, that's what took it all back, was the big rise in the dollar yesterday. So today the dollar's off a little bit. What's interesting is Japan, you've got a yen that's just epically low. And Japan has been implementing yield curve control. If you want to know what that is, if you read this morning's note, I give you a brief explanation of what yield curve control is. And so they're suppressing their interest rates. They're still trying to stimulate their economy, still presumably trying to create inflation, but the yen has just been a disaster. Now, historically that had been by design to boost Japanese exports, but today it's a hit certainly to the Japanese consumer. So overnight, Japanese officials stepped into the FX market and started asking about rates, things that they do prior to intervention. And so the market's reacting to that. As I speak, the yen is actually up like 1.25%. That's a big move for a currency, and that's helping the dollar lower. The other thing too, the euro, which is the biggest counter currency, explains the lion's share of the dollar move. You've had this big interest rate differential between the US and the Eurozone, but the European Central Bank is talking very tough now as well. So that's provided maybe some support for the euro. We think the dollar ultimately over the next several years will trend lower, and that's very bullish for a lot of the positioning that we're establishing right now. And in the near term, we thought it got way overbought and that was a plus relative to the equity markets and the commodities market. Well, yesterday, of course, that went against that grain. We'll see how this plays out going forward. But you look at today, as I looked, the S&P's up 0.2%, the Nasdaq's up 1%, Nasdaq 100, and the dollar's down, right? So that's that negative correlation to stocks, which makes some sense to us right here. In terms of what futures traders are doing to these currencies, here's the rabid still bullishness in the US dollar. Okay, so we spent a lot of time on what short interest looks like. When you shorted something and it goes against you, ultimately you have to cover anyway, but when it goes against you, you can cover in a hurry, or you need to cover in a hurry, and that can push the price of that thing up. The dollar has been incredibly well bid in the futures market, so this is the net positioning, so very bullish. So what does that mean? That means that there's the potential for some serious selling. Now this is only as of last Tuesday, and we won't get this week's until Friday, so it'll be interesting to see to what degree some of these bulls may have given up, as we've had this dollar decline here of late. Now the opposite is the look for the euro. So the euro is pretty net short, right? So again, remember that the euro is the biggest, call it, countercurrency in the dollar index. So if folks start buying the euro because they think the ECB is going to be hawkish relative to the Fed, or that European assets are beginning to bottom out and people will start buying them, there's an advantage there, currency-wise, yada yada. Or the Russia-Ukraine situation, which has been very dynamic the last few days, comes to a resolution that I suspect would be hugely bullish for the euro. And to add to what would be fundamentally bullish for the moment, you've got these shorts that need to cover, and that could push it up higher as well, just like I talk about for the stock market. So lots of interesting dynamics, cross currents. We could get into commodities from a variety of angles and how that might impact equity markets and yada yada. But for today, suffice to say that we fell right to that technical support on the S&P, and that's holding for the moment. Looks like in the options pit, there's some alleviation of implied volatility, so that's bullish as well. So we could see, this hang on here for a day or three. I'm not making a big bet one way or the other, or I'm not making a prediction one way or the other, I should say. Ultimately, I think this is a very precarious setup. We know what the Fed's going to do at least next week, and that's a 0.75% rate increase, right? There's some hints that maybe 100 bips is in the offing. There is a Wall Street Journal reporter that clearly kind of gets a heads up during the blackout period or the quiet period for the Fed, when they want to give the market a heads up. So everybody is paying very close attention to the tweets of Mr. Timorous, as are we, because it has so far seemed to give us real insight as to what's going to happen. So if he starts talking a lot about a 1% rate increase for the Fed funds rate, then this market is going to suffer leading into that meeting, because it's not a mystery these days that this guy does kind of get a heads up from the Fed, if they want to give the market a clue or give the world a clue what they may be up to, as to not shock everybody when it ultimately happens. So if he pushes against that, then that 75 bips is in. So it could be, who knows, that market sells off a little bit more, or maybe yesterday's was enough, and suddenly 75 basis points is dovish because the market was thinking maybe it's 100 bips. So folks, lots of emotion, lots of short-term gaming in this market that's creating a lot of volatility. Ultimately, I can assure you this thing will find a bottom, and we see some things that are getting more attractive by the day that we're looking forward to adding to the portfolio or increasing within the portfolio. Just ain't there yet, frankly. Folks, thank you as always for watching and listening. Have a great rest of the day. I'll talk to you later this week about the economic setup, and then we'll update you on the equity markets as well. Take care. Bye-bye.